name is Jeff Infante with Real Estate Talk Today, and today we have a special guest today, as we always do. But before that, we have our partners here, Josh DeBoussard and Jenny Clemens. And today we have Cindy Vo from Samper Home Loans, correct?
Yes, thank you for having me. It's such a pleasure and an honor to be here.
Great, awesome. So, Cindy, before we get into the questions, we always like to interview everyone and kind of ask questions so the consumers can get more knowledge of what's going on in the mortgage industry, et cetera, everything relating to real estate. Tell us a little bit about yourself, how long you've been doing this, and all this good stuff.
I have been in mortgages for a little over 5 years. I love what I do. I love helping, people realize that they can own a home and that there is hope for everybody. There is the American dream.
Right.
So,
awesome, awesome. So, great. So we're gonna dive into it. So, what is stopping the consumers out there from buying a home? Like, what is going on? Like,
I think the biggest thing is people are scared. And, as people who don't own homes, we've all been there. What's the first step? I don't know. Is to contact a lender. Contact me, and there's many things that we're going to review: credit, income, assets, things like that, just to see what your viability is, goals are. But it's just getting over that hurdle of being scared. You guys have been paying rent for years, 10, 15, 20, 30 years. So what is so scary about investing in yourself instead of somebody else?
Right. So you think about that for a little bit, right? They've been comfortable paying rent, right? So it's sort of is either you pay rent or you're paying a mortgage. You still have to make a payment regardless, right?
Exactly.
So it's just a transition of mindset, pretty much, is what it really comes down to, right? Breaking that ice for them to see that home ownership is a great thing,
right,
and is a positive thing, right? Because I think we spoke about this before, where we did an analysis where, a person who pays rent every single month throughout the years pretty much loses that money and doesn't gain anything back. As a mortgage, you kind of gain the equity out of that. Tell me, for those people who are out there listening that are sort of in the fence, they're renting right now and they want to make that, what are some key core things that the lender looks for so that the person who's listening can grab that information, say that I can do this? What are those things that they look for? So
there's, when somebody's looking to buy a house, as a lender, we have to consider that we're lending up to 30 years, So buying a vehicle, I always use this analogy. Buying a vehicle, you usually test drive the car first, and then you go for the financing. Buying the house is completely opposite. We need to qualify you because we're lending for 30 years. Would you want to lend somebody money for 30 years without doing some kind of investigative work or qualifying work? So there's a few things that we look at. The core things are basically, what is the client's ability to repay? And how do we figure this out? We figure it out by reviewing the CIA, is what we call it, or like I like to call it, is your credit. Is your credit viable? Your income, do you have a consecutive 2-year work history? And what is a 2-year work history? A lot of people also have the misconception of, I have to be at my current job for 2 years. That's not true. But it does have to be full-time. And, if any questions, you just get more into that when you're at a consult. Right. And then assets and liabilities. So, what do you have for assets? Do you have the ability to save? In liabilities, how do your liabilities outweigh your income? So those are pretty much the core things that we look for. Right, nice. Okay, that's interesting.
Now that you're talking about that, talk to us a little bit about debt to income, because I know a lot of people don't understand what that means. Can you explain that to us?
So one of the biggest things right now is, I know a lot of people, a big hurdle right now is a lot of people are buying cars, right? That's a huge, and everybody needs a new car or likes a new car, or just, you just have to have it. You need it for your family, for work, everything. So one of the biggest things is when we look at debt to income, it's your total monthly income, your gross monthly income, okay, that we look at. And your liabilities is also something that reports monthly on your credit. Everything is looked at every 30 days. That's why credit bureaus report, every 30 days. So let's say you buy a car, Jenny, and you bought a let's say you bought an airplane. Even better,
Ooh.
right?
Wow.
You got a jet.
I'm hanging out with you, man.
Let's say you bought a jet for $3 million. You financed $3 million, right? But the payment was only $200 a month.
I love it.
Of course,
I'm buying a jet.
of course, we look at the overall liabilities that you have, but it's basically broken down by month. You just finance something for $200.
Okay.
You know, so how does that affect you? Well, if you make, you know, $4,000 a month, $200 is really not that much.
Okay.
Right.
But if you make $2,500 a month or $3,000 gross before taxes per month, you know, a $600-700 car payment, you know, is a huge hit
Significant.
to your debt to income.
Right.
That's huge.
Yeah. So what would you say? Because I get this a lot. You guys already heard it too, probably. What about when they say, "But if I buy a car, it's gonna help my credit"? Do you get that?
I do, but at the same time, if it's possible, you know, if you're looking to buy a house and you need to buy a car, still talk to a mortgage professional first.
Yeah.
You know, we can't advise on what car you want. That's the car professional. But, you know, you're going to have to do what you have to do. If you have to have somebody, you know, buy it with you or something like that, or have your spouse put it in their name instead, and you carry the mortgage, that would make more sense. But don't do something that big, because that's a big purchase, without consulting us first.
Just wait on the car. Buy the house first, then you buy the car.
Right.
And another big
Good
misconception people have about debt is, oh, well, I'm not ready because I have to pay off all my credit cards. That's not true. What if you pay off the wrong one? You know, because we look at the monthly, not the total. You know, I have a $10,000 credit card, but the minimum payment's only $50 because I have 0% interest or something. But then I have a $300 credit card, but the payment's $80 or $90 a month, you know, so it might be better to pay off the $300 credit card versus the $10,000 credit card.
That changes the way I look at financing things now. I never even knew that. I figured you guys looked at the sum,
total amount,
the total.
right.
Right. Of course, you know, when we run it through the system, the system does look at your total liabilities and looks at your risk level, but that's not up to, you know, the loan officer themselves. It's up to the system.
Okay.
Okay.
So you guys focus on the minimum payment.
Yes. Yep. That reports to credit.
Okay.
Yep.
How about Credit Karma?
I love Credit Karma. Don't you guys love Credit Karma?
Yeah, I have Credit Karma.
This isn't a sponsor for Credit Karma.
No,
Let's put
absolutely
that in
not.
real quick.
But
How accurate? I mean, I get the notifications when, you know, something comes up, but I'm just like very skeptical how accurate it is.
Yes.
yeah.
Because it, you know, I look at my score, I'm like, oh wow, like this is impressive. But then when I go in, like, oh no, it's this. I'm like, no, you're wrong. Like Credit Karma says it was this amount.
Yeah.
So what's going on with that?
So I personally love to use Credit Karma for my stuff just so I can see my utilization, you know, just to have a gauge on what my real credit score is. Credit Karma, all of those third-party apps, Credit Sesame, even Experian.com.
I have that.
Those are not your true government credit scores. Those agencies are not government credit reporting agencies, okay? So it's a good tool to have to gauge where your credit is. I always tell my clients, if your credit score is 750 on Credit Karma, you should probably subtract 20 to 40 points.
Wow.
Very seldom is it over. Is it plus 20 to 40 points, okay? They always paint a good picture. And I always get the question of, well, you know, you pulled my credit, but, you know, my score dropped, or it says my score, my Experian told me my score is 800, but you told me it's 690, you know? I don't work for the credit bureaus. I don't know how that stuff works. But I know that we pull a full government credit report, and what we pull is accurate. Okay. Actually, everybody has access to their government credit report. Did you guys know that?
Once a year, right?
Yeah,
You
I think
it
they
free
get one.
once a year.
It's an annual credit report.
I think it's free annualcreditreport.com.
Okay.
You have to actually put in like a credit card. It charges you $1 or something. So you don't have to pull all three bureaus. What you can do is you can pull one bureau in 3 months, and then the following, 3 months, quarter, you pull the other bureau, just so you can gauge what your credit is.
Oh, wow.
But it doesn't hurt for just to contact the lender, because again, it doesn't cost you anything as a consumer to have us pull your credit.
Now,
you know?
how many points
I was gonna
does
say
it
that.
drop?
Yeah.
Oh,
I don't know.
Right?
I don't know
No.
because what happens is
It's different for everybody?
no. So of course, if I get my credit pulled, I get that, horrible email. Your score dropped 40 points. You had a hard inquiry. But when we pull your credit report's good for 120 days from the day that I pull it. So if I pulled your credit report today, you can close on a house within that 120 days, and I'm going to use that score.
Okay.
Okay.
So, because I know there's people that they go shopping around because every mortgage company has slightly different interest rates or whatever, or they give them a little discount here and there. So, so I had this one client says, well, I don't want to go to different lenders because it's going to keep knocking down my score. But is there like a window where they can still
A window of opportunity?
Right. Well, yeah.
Yes.
I would
It's
say.
just like car financing, right? You do have a certain time to shop. I mean, correct me if I'm wrong, it might be 7 to 14 days. I don't
For a
know.
car, right?
Yeah,
Oh,
well,
okay.
for any,
Okay.
I heard
as
it
long
was,
as it's
I
the
heard
same.
it was 30 days, but I
30
don't
days,
know.
okay.
I don't know
It might be 7, 14 days. I don't know because if people are shopping for rates, it's not a good idea. You really need to connect with the person you're working with and make sure you're comfortable when you review your goals with that person,
Right.
that you're comfortable with that monthly mortgage payment.
Right.
Of course, rates are going to differ, but programs differ. Every
Right.
client is not the same client.
Exactly.
So this person who got a 3% rate, the next person might have a 3.5, or that person might have a 2.5. Every scenario is different, and everyone's qualifications are different.
Right.
And to put into perspective, so with different mortgage companies, I mean, the interest rates, I mean, they're not going to vary by like a substantial amount. You're
Right.
probably looking at a small fraction
Literally a
of
fraction,
difference,
yes.
which is not going to really make a big difference in your payment, right? Because if your credit is X, right, and you quoted a 3.5, they might go to another place and maybe get it at, 3.49 or something, right?
But that's a quote.
Right. It's a quote.
Nothing is locked. Nothing is guaranteed unless it's locked.
Because it changes, right?
Right. It changes every day, just like the stock market.
There you go.
Everything changes every day.
Okay.
So, if I pre-approve somebody at 3%, the rate might go down by the time they get under contract. So their rate might be 2.875.
That's important.
But the rates have gone up in the last, month, even in the last 9-10 months, they've climbed.
Yeah.
So anybody can say, oh, well, you're pre-approved, your rate is 2.5.
Yeah,
right.
We
Yeah, I
know
get that.
2.5 doesn't exist.
Right, yeah.
At no
yeah.
cost.
Right.
You said
So-
keyword locked. So can you just elaborate on that? What's locked and when does that happen?
So usually when you are under contract, there's a certain time frame that you have to buy the house. Buying a house usually takes 30 to 45 days.
Yeah.
On average, in a perfect world, 30 days, right? So we need to lock your interest rate, and that lock date needs to happen on or before the closing date. I mean, not on, but a little beyond, I'm sorry. So let's say we were to close, 45 days from now. I would need to lock your loan for 45 days, okay? And then your rate is locked. Usually it's fixed for 30 years. The rate doesn't change for the life of the loan.
Does the lock expires?
Yes, that's
And-
why you have to lock within the time that you're going to close.
I see. And what happens if it expires?
Well, it depends.
Yeah.
It really depends, and these are a lot of scenarios that people run into that they're not educated about. So when there's usually an extension, there's a cost to extend the rate. So usually before your loan officer advises that we need to lock your loan, they might want to contact the buyer's agent and say, is there any chance that we might not close on time? People have to understand that the closing date on a purchase contract is the goal date. It's tentative. I always tell the clients it's tentative. Don't call out of work that day. Don't put in that you
Right.
need the time off. That's tentative. We can close earlier, we can close sooner, or we can close on that date. But that is the goal date.
Right.
So we usually advise them to go ahead and that we need to lock it beyond that date, just in case, or that date. So I would call Jenny, for example, and say, are we going to close on time? Or do you think is the seller buying another house? There's a whole domino effect that can happen. And there are costs to extending a rate. So talking to your lender about that is very important.
Who pays for that if it extends?
There's many ways that can be paid. The buyer usually has to pay it.
Okay.
And it's a certain percent of their loan.
Gotcha.
The seller can give a credit if it's the seller's fault. The buyer's agent might want to request the seller to cover that maybe
We're
something.
smiling because that's a touchy subject.
It's a very,
Yeah, it is.
very,
It
it's
is.
a very touchy subject. Asking somebody to cover costs is a touchy subject.
Yes.
The lender can also give a credit to help offset that.
Right.
You
Wow.
know, so there's many ways.
Wow. All right.
So now, let's say I'm your client. We've done everything. We've been through the whole 9.
Yeah.
What's next? Like after I've supplied everything, what else?
So
what's the next step?
we've reviewed your credit, your income, your assets, your liabilities. What we do is, well, you've obviously provided me pay stubs, W-2s, if you're a wage earner. We would meet, whether it's in person or virtual. I would review your goals with you, what your monthly budget is, go over the different financing options. Do you have money to put down? What type of financing? And educate you on the type of financing. There's so many different types of financing, so there's a lot to go over. As a first-time home buyer, you want to know, even if you're not a first-time home buyer, what if you bought a house years ago? There's different things that we would have to review, and then I would officially pre-approve you, and you would go out with Jenny, look at houses. You would text me the address to a house, and you put an offer in. Then you have to put a deposit on the house if your offer is accepted. Yeah. So this is called an EMD, or earnest money deposit, just to show that you're viable. Number one, that you're viable, and number two, that the seller would not consider any other offers. You're under contract now. You have a due diligence, and so does the seller.
And what happens to that deposit?
It's held usually by the seller's attorney in an escrow account, and that's usually applied toward your down payment as a buyer. So if you put a $5,000 deposit, your down payment is $10,000, then the difference of your down payment would be brought to closing of $5,000.
Right.
Yeah.
I have a quick question. I know Josh, I have another question.
Yeah.
This is getting interesting. So I had someone asked me, and I just referred them over to the lender, obviously, and I never got to find the answer to this. But what happens, right? There's all these programs out there that provide incentive for the first-time buyer, right? All these these grants that are out there, right, for first-time buyers. If they were to give a large deposit, let's say a $5,000, $6,000 deposit, right, and they're getting all this credit back, do they get that money back?
Yes,
They do?
absolutely.
Okay.
So we've had plenty of buyers where they put a $5,000, $10,000 deposit, earnest money deposit, to hold the house, and if their down payment is covered through some kind of state agency for down payment assistance, if the seller has given closing cost credit, or if they're using a state agency for closing costs as well, they will get their full deposit back at closing as long as it covers all of it. So we've had plenty of buyers put a $5,000 deposit on the house, and they leave the closing table not only with that $5,000 deposit, but with the keys to their new house.
Nice.
That's awesome.
Yep.
Pay me to buy a house.
Yeah, basically.
Where do I sign?
Yeah.
Nice.
So now, what do I need to bring at the closing, for the closing?
Just usually the closing attorney or title company would advise of that. And usually it's your ID, a bank certified check for the difference of your down payment, or you might not need to bring anything. And then just smiles and a strong signing hand. Yeah, and then we
Nice.
celebrate.
Nice.
Yeah.
Awesome.
Nice.
Okay, cool. Do you guys have any more questions? Or?
No,
No,
thank
all
you
right,
so
cool.
much,
So
Cindy.
thank you very much. I really appreciate your knowledge and sharing it with the public. And well, for you guys, I hope you guys enjoy this as well. And till next time, thank you for joining us in Real Estate Talk today. My name is Jeff Infante, Josh DeBassard, and Jenny Clements. We'll see you soon. Take care.
Ciao.
Bye.